Hey everyone, welcome back to Corporate Decoder, the place where we read between the lines of corporate filings. And let's just say our decodering is about to get a serious workout with this one. Get ready for a deep dive into Monroe Capital's latest EC filing, where we'll uncover their plans for billions in lending, the risks involved, and of course the juicy details hiding in the financials before we dive in. If you want to stay ahead of the curve on what is really happening in the corporate world, make sure you're subscribed. And hey, join our Discord community linked in the description below. It is where the real decoding happens off camera. So what is the big story here? Monroe Capital Enhanced Corporate Lending Fund is looking to raise a whopping $1 billion. This is a brand new fund aiming to lend to small to medium-sized businesses, the kind that might not get a second glance from big banks. They're calling themselves a business development company, or BDC, for short, which is a special kind of investment company focused on helping these smaller companies grow. They're planning to invest mostly in loans, like senior secured loans, where they get paid back first if a company runs into trouble. Think of it as loaning money with a strong guarantee. They're particularly keen on businesses with steady income streams and tech companies that have a good chunk of their revenue locked in through contracts. Now let's talk about the money, because that is where things get really interesting. They're re-aiming for this massive $1 billion offering. But hold on, they are offering 3 different classes of shares: Class S, Class D, and Class I. The main difference is in the ongoing fees. Class S shares have the highest ongoing fees at 0.85% per year, then Class D at 0.25%, and Class I shares have 0, at least in terms of shareholder servicing fees. This means your investment in Class S will shrink a bit faster each year due to these fees compared to Class D, and especially Class I if you are investing $1,000. Those fees add up. For example, over 10 years, you pay about $976 in cumulative expenses on a $1,000 investment in Class S shares, assuming a steady 5% annual return. That is nearly a tenth of your initial investment just in fees over a decade. Class I, on the other hand, costs about $953 in those same cumulative expense scenarios. It really highlights how critical fees are in the long run. Out of that billion-dollar target, after accounting for organization and offering expenses, they estimate about 99.44% will be available for investment. That is a pretty good chunk, about $994 million in total from all 3 classes of shares, assuming they sell the maximum. If they sell the maximum of each share class, that is about $333 million for each. These expenses, despite being a small percentage, represent over $6.6 million in initial costs like legal, printing, and advertising. It is important to note that Monroe Capital itself is covering the first $1 million of these costs, which is a good sign. But the rest you, the investor, will ultimately bear indirectly. So while they're re-pushing for $1 billion, the actual investment capital will be slightly less due to these upfront costs. Now, when you are in the business of lending, leverage is often part of the game, and Monroe Capital is quite open about it. They explicitly state they expect to use leverage, meaning they plan to borrow money to make more investments. This can magnify gains, but also losses. They mention interest payments on borrowed funds could be around 9.13% annually, which is a significant cost of doing business that will eat into returns. It is like borrowing money at a high interest rate to lend it out for potentially even higher rates. But if those loans sour, the borrowed money magnifies the pain. And speaking of risk, they do not shy away from it. They list out a whole lot of risk factors, and it is crucial to understand these. They're a new company with a limited operating history, a common theme for new funds. They depend heavily on their management team and warn that if key people leave, it could hurt their ability to hit their goals. Plus, managing other people's money comes with conflicts of interest, which they explain in detail. They're also up against tough competition in the private credit markets from other funds that might be bigger or have lower costs. And here is a big one: their investments are likely to be in below investment grade securities, often called junk bonds. These are riskier, meaning to raise a higher chance the companies they lend to might not pay them back. Let's look at those different share classes again. Class S shares, the ones with the highest ongoing fees at 0.85% per year, are available through brokerage accounts. This fee isn't paid up front, but it chips away at your investment each year. Over 10 years with a 5% return, those fees alone could amount to around $85 on every $1,000 invested. Based on their examples, it is a small percentage, but it adds up significantly over time, impacting your overall return. After a fee waiver, the total annual expenses are still quite high. For example, Class I shares, which have no shareholder servicing or distribution fees, still have total annual expenses around 12.03%. After the waiver, Class S shares are looking at 12.88%. This includes management fees, interest payments on borrowed money, and other operational costs. These ongoing expenses are a substantial drag on potential returns, making it clear that Monroe Capital is betting on generating truly exceptional returns to overcome these cost hurdles. When we look at their investment strategy, they're putting a lot of eggs in the lower middle market basket, which carries its own set of risks. These companies are often smaller, less established, and might not have the same access to capital as larger firms. This means they could be more vulnerable to economic downturns, defaults, and even bankruptcy. They also mention a focus on technology and software companies, which can be super volatile. The hope is that their specialized knowledge in these sectors will offset some of the risks, but it is a high stakes game. They also acknowledge that many of their investments will be in illiquid securities, meaning they can't easily sell them if they need cash, which ties back to their very limited share repurchase program for investors. So, what is the takeaway here? Monroe Capital Enhanced Corporate Lending Fund is aiming for big returns by lending to businesses bypassed by traditional finance, and they're backing it with a massive fundraising goal. Their strategy of focusing on directly originated loans and specific sectors shows ambition, and their experienced team gives them a fighting chance. However, the high fees across all share classes, the reliance on leverage, and the inherent risks of lending to smaller, less stable businesses are significant hurdles. Investors need to be absolutely certain they can afford to tie up their money for a long time and accept the possibility of losing it all, as the filing makes abundantly clear. This is not for the faint of heart or those needing quick access to their funds. Alright, that is our deep dive into Monroe Capital's latest filing. What are your thoughts on this aggressive lending strategy? Do you think they can pull off $1 billion raise and deliver those returns? Let me know in the comments below. If you found this breakdown useful, give us a thumbs up, it really helps the channel. And of course, subscribe for more corporate deep dives. Don't forget to join our Discord community linked in the description for even more discussions like this. Thanks for watching, and we'll see you in the next episode of Corporate Decoder.